Profitability analysis.
The core principle outlined is that every business decision must be grounded in solid financial analysis. The primary goal for most companies is to maximize investment value to generate profits for shareholders. However, even nonprofit organizations rely on financial stability to ensure their longevity and ability to fulfill their missions. In the context of international trade, financial analysis is crucial for determining whether an opportunity is truly beneficial. A proposal that seems attractive on the surface, such as a higher selling price from a foreign buyer, may become unprofitable once all associated costs are factored in. Using the example of an avocado producer, an export deal with a 15% price increase might be less profitable than a local sale if the additional logistics and export expenses eat into that premium. Therefore, a detailed financial analysis is essential for selecting the optimal path. To determine the best option in foreign trade, a company must weigh the potential gains against the specific costs and factors involved in the international transaction.
Break-even point and contribution margin.
Break-even analysis is a financial tool used to determine the point at which total revenues from a transaction exactly equal total costs, meaning there is no profit or loss. This helps a company understand the minimum performance required for an operation to be viable. To calculate this point, a company must identify all associated costs, which are categorized into two types. Fixed costs, expenses that remain constant regardless of sales volume. In the export example, the freight cost for a full container is considered fixed because it must be paid whether the container is full or empty. Variable costs, expenses that fluctuate in direct proportion to the number of units sold. Production cost is the primary example, as total cost increases with each additional unit produced. By knowing the selling price and separating costs into these categories, a company can calculate the sales volume needed to reach the break-even point.
To determine the break-even point of a sales operation, the following formula can be used.
The break-even point, profitability threshold or balance point, happens when a company's revenue is equal to its expenses. In other words, the company earns the same amount of money it needs to operate. A break-even point analysis indicates the amount of revenue needed to cover expenses before being able to generate profit. It is a basic and easy calculation. The only elements we need to know to carry it out are fixed expenses and sales revenue. For instance, if a company spends $10 to produce and sell a soccer ball and is considering to market it to a client in Brazil by means of a ball container at a price of $35 per piece. The best freight cost they obtained is $2,500, including delivery at the designated place. Fixed and variable costs will be omitted to simplify the example.
In conclusion, if the company issues 100 balls in this sales operation, it will not gain or lose profits. The company would start making revenue after selling the 101st ball.
Following the previous statement, a new concept is brought up: what profit is made per each additional ball sold. In the financial world, this is known as contribution margin. A contribution margin represents the profit a company earns per product unit sold, only considering variable costs and not fixed ones. The concept of contribution margin is defined as the difference in selling price minus variable costs. It is also considered to be the excess of revenue in relation to variable costs, an excess that must cover fixed costs and profits. Based on this definition, simplify it as the selling price of a product minus the cost of producing it.
In the latter example, contribution margin is as follows.
This indicates that the company will earn $25 per ball sold starting from the 101st ball, as the first 100 balls will pay for the freight cost. This business is profitable for the company as long as it sells more than 100 balls. If not, the sale would represent a loss. It is significant to emphasize that freight does not represent a fixed cost for accounting. It does in these examples because the freight cost does not change regardless of the amount shipped. This is applicable to a company's regular logistics operations, helping it make decisions on the possibility to carry out shipments with their given costs.
Analysis for decision-making.
In foreign trade, profitability is linked as a competitive advantage, and a profitable country is distinguished from another when it has a lower production cost than the rest. In this sense, companies must analyze the products that provide them with this advantage to encourage export practices and, thereby, promote the country's development. Shikaiza and Jimenez, 2023. By using the break-even point and contribution margin formulas, it is possible to make conscious and accurate decisions that guarantee profits for the company when performing business operations.
For instance, the soccer ball company from the previous exercise has a sales opportunity with an Australian client interested in its product. They placed an order for 3,000 balls at a $12.50 price. Because of company policies, the contribution margin it must obtain has to be of at least 21%, so that it covers risks and eventualities in the transaction. After understanding the basis of the break-even point and the contribution margin, the following can be determined. The company has a policy of a contribution margin of at least 21%. If this was not the case, it would determine the maximum freight cost to learn if there is a possibility of obtaining profit from this operation.
Now it is known the maximum freight cost is $7,500. If the company gets a transportation quote for $3,000, would it be convenient to carry out the operation? It would clearly be convenient even though there is a 21% policy. If it is an opportunity that the company can benefit from, it is better to carry it out, as long as it does not affect any current company clients located in the same region that could be direct competitors of the purchasing company. Performing a financial analysis of operations helps companies make effective decisions based on the information specific to each case. It also offers a chance to adapt this type of analysis to practically any case by simply considering adequate pieces of information that have an impact on each activity. In addition, the complexity of the analysis can be as simple or as elaborate as the company requires, allowing any argument regarding a business to be supported and accurate decisions to be made. It should be noted that to measure export performance, 3 variables are usually used: economic, non-economic, and generic. Economic variables include sales, profitability, and market share. Non-economic variables highlight those related to the market and the nature of the product. Generic variables encompass those related to the decision-maker's perception. Katz et al., 2000, as cited in Valencia et al., 2021.